Let's talk about the connection between the stock market and bonds with Meb Faber. He's the CIO at Cambria Funds. Meb, we're going to get a little bit academic here, but first, just a little talk on GameStop, because your guys' fund has one of the highest concentration positions in GameStop. How long has it been in there, and what do you do now after this explosive run?
Well, good to be back, guys. Oliver, good to see you. You know, I'm a quant, so half the time you ask me what's in all these funds, you know, we have a dozen, I don't even know, particularly in some of these emerging markets. And GameStop, I know, only because when I check our quote screen and see things that are up 50, 90%, I'm usually a little bit surprised. We've actually owned this for a long time, so that's the bad, that's the bad part. We were part of it when it was going down and also on the upside. You know, I think it is characteristic of two things real quick. That I think people don't understand. One is when you have a security that's been beaten down, particularly at cheap valuations, you have a few catalysts, you have a few big fund managers, in this case, catalysts like new entrepreneurs joining the board, you can have explosive moves to the upside. We've seen that with Tesla, particularly the extremely high shorted names that can have these short squeezes, and you have these massive moves up. Second is an interesting part that not a lot of people know much about, which is a lot of the long funds, such as ourselves, that own a security like GameStop that's heavily shorted, actually can lend out the securities to the short sellers and charge a high borrow fee. In the case of GameStop, it's like 15 percentage points per year.
Wow.
And we return all that revenue to shareholders. And so for many funds, many investors don't know this, the management fee of the fund can be partially or completely covered by the short lending revenue. In the place of cannabis, you have actually what we would consider to be a negative 200 basis point, 2 percentage point yield on these funds, meaning you're getting paid to own these funds. Pretty cool. Check it out. A lot of people talk about it, BlackRock, Vanguard, et cetera. It's not just some quirky part of the investment universe, but I think it is a really interesting part that people don't know much about that is a wonderful feature of ETFs.
So then if you're long GameStop too, I mean, the point is you can mitigate some of that, right, and go towards the overall operating costs of the fund when you're lending them out. What I'm curious about is what we've been looking at in this market that kind of connects to the broader conversation we're going to have today is about these companies that might be deemed kind of value stocks that have been beaten up. A lot of them have had such a reversal now over the last few months. We were just talking Goldman, which has just exploded up to all-time highs for banks. How do you go through now and kind of gauge these short-term expansions of the valuation for the most part? I mean, this is mostly valuation expansion that's happened for some of these cyclical names before these earnings have kicked in. Is that going to change the way you view these companies? How do you assess kind of these short-term valuation expansions versus, you know, what you're looking for from a traditional value metric for something that's a value stock?
People love talking about the market in general, right? Just the market as if it's just one animal. And I'm sure we'll get to the valuation of the overall market in a minute. But really, the quote that I think is more accurate is it's a market of stocks. So you have times it's like a swarm of bees or starlings, right? Like it changes shape over time. And so there are periods where the market looks very uniform. There's periods where there's massive dispersion in valuations between size, maybe large cap versus small cap, or sectors. You have a scenario in the U.S. where energy used to be almost a third of the S&P 500, and now it's like 2 or 3%. So very different composition over time. Right now, after 2020, you know, the carnage in Q1 set the stage where a lot of these, you reference, particularly small cap value stocks, got absolutely obliterated, right? Q1, some of these were down 50%. Now, you've seen what I consider to be a regime change since the bottom in March, and then kind of doubled up since the election in November, where a lot of the macro factors at play over the past decade have shifted. U.S. dollar has now been moving down quite a bit. You've had a rotation into other securities, such as value, which has been terrible forever, such as foreign markets. Will that continue? We'll see. But particularly within the U.S. market, you have pockets of opportunity like the small and mid-cap value stocks versus a lot of the high-flying tech and large-cap growthy type of names, which we think are really expensive.
Now that's where it comes down to this thread. You had a really long thread, an extensive one. I was joking, if people got all the way through, which I did, I feel like we deserve a medal. Meb, this is like the longest thread, but it's great because there's a lot of details here, and it really hits home at probably the most commonly heard and repeated trope of the market right now is we don't need to worry about stock valuations from a future returns perspective because rates are so low and they justify. So this is kind of a complex conversation because there's a backward-looking kind of definition of justify. Okay, how did we get here? But then going forward, what kind of returns should we expect? And I'll kind of cut to the chase. It seems like your overall takeaway is that I think you're talking for the S&P 500 that your odds of getting big returns are probably pretty low right now. Your base case is like for 0 to 2% over the next decade.
Yeah. I think you have to be prepared for no returns on stocks and bonds for 10 years. And let me flesh that out. And by the way, the reason we did this long tweet storm is we just want to meet people where we are. You know, we started out with academic papers and books, blah, blah, blah. But, you know, if investors want to hear our content on YouTube or podcasts, we haven't done it yet on TikTok, but, you know, we're happy to post it wherever. So the starting point for this, the inspiration was I did a poll a couple years ago where I asked people as stock market continued to ramp up, I said, would you continue to hold stocks, you know, based on certain valuations? And historically, if you're looking at like a 10-year P ratio as a foundation or a ballast, and the valuation metric doesn't matter, but 10-year P ratio, the CAPE ratio, we like to use because people are familiar with it. And we say historically that's around 17. It's been as low as 5. It's been as high as 45 in the internet bubble. I said, would you continue to hold stocks if the valuation hit a P ratio of 50, so higher than it's ever been in the US, higher than it was in 1999, and over half said yes. I said, would you continue to hold stocks if it went to as high as it's been in any country ever, which is Japan in the 80s, at a valuation of almost 100? And a third said yes. And that's crazy to me. If you look at the examples of history, the Japanese stock market had no returns for 30 years after their peak bubble, the biggest bubble we've ever seen. The US stock market after the internet bubble had two massive 50% drawdowns, no returns forever. It's been very meager returns. So my point being, it's weird that people are valuation agnostic. And one of the reasons is they don't know what else to do. They look around and say, well, I get 1% on bond yields. I can't invest anywhere else. I'm forced into stocks. And the justification you mentioned is interest rates are low. So we went through this whole thread. We said, well, historically, when interest rates were low, were stocks expensive? And no, historically, they were actually cheap. And then we flipped it. We said, well, historically, when stocks were expensive, were interest rates low? And no, they were like 5%. But the key question, which you alluded to, that people want to know is not, are stock valuations justified? Right. It's, are high valuations currently with low interest rates, does that portend good or bad future returns? And there's good and bad parts to this. It's never as simple as one variable. Low bond yields historically have led to higher future stock returns. Low real bond yields, so after inflation, have led to higher stock returns. The problem is, historically, that's been associated with really low valuations. So we're talking PE of around 13, okay? Not 34, which is where we're at. It's been associated with trailing 10-year, not very good economic growth with terrible stock returns. And the simplest way to think about this is, usually the good times lead to the bad times and vice versa. I know that's super technical, but that's the reality of it. Right. And so what happens is you have a scenario right now where you have all the characteristics of a starting secular bear market, okay? But the only thing different is interest rates are low because you could call it Fed manipulation, you call it whatever you want. But all the other variables point to the other side. And if you go look at the thread, we can't get into it here because I don't think we have enough time. We looked at the 20% of the best starting times in history to invest in stocks and what were the characteristics. And the biggest one that had the big impact is valuation, right? You started from low valuations, you had a tailwind of multiple expansion, which ended up being like 6% per year. And then if you looked at the worst times, which was roughly zero return, it was the same on the opposite. You had a high starting valuation, which declined over time. Could that be wrong? Could we have this American renaissance of absolutely skyrocketing growth? Maybe. I hope so. That would be awesome. But at least prepare mentally your portfolios for the possibility of the bad times. That way you won't be disappointed.
So a few takeaways here. One is that even though low yields in the past seemed to presage bigger returns, it was more because the valuations at the time of low yields were also very low. So ultimately, the determining factor when you strip things out, according to your analysis, is that it still is more about valuations. One of the things I also took away here is you mentioned, okay, basically the way that we could get much higher returns than your base case is if there is an explosive degree of innovation. And just technically speaking, from a numbers perspective, using the CAPE ratio, in order for us to get a decent 6 to 10% of return or whatever, you'd have to get back to at least the .com very tip-top highs for CAPE. That's one specific metric. A lot of other metrics were already there, like price to sales, et cetera. So for this metric, we have to get to .com or beyond. I guess the last thing I'd be curious about, Meb, is what would be the next step to trying to gauge how much of that innovation might still be left in the tank? Could you go into, say, a basket of the most innovative companies? Like, what if you took the ARK fund or something that people love, this high growth fund, go in there and say, okay, how do these valuations and all these different metrics set up to, say, a similar .com fund then, and compare them? Any idea what that might look like to see how much real innovation we might have left?
Two comments here. The first is I love Kathy. They've done a great job. But as you think about the future, some of the questions you're asking are essentially, can we predict the future? And that's the hardest part of all this. We often say investors would better suited stop trying to be a Nostradamus, predict the future, and be Rip Van Winkle. You know, just allocate and move on. And the reason being is that the variables that are hardest to predict, we do know that low interest rates, people will pay a little bit more. That's particularly because of inflation. This moderate inflation period wherein people pay a little more, not the 34 wrap, maybe from 17 to 20. Interest rates going down cause multiples to go up. We know that, but we're already at low interest rates. So the good news is, I love to end on a positive note, the rest of the world is cheap. You know, I've been on this show talking about this for a while, and we're finally see the foreign markets start to pick up, particularly the emerging markets. S&P is at 34. It's the second most expensive country in the world, we calculate. Foreign developed down around average countries around 22. Median country down around 17, emerging markets 15, and the cheapest bucket is down around 12. And then you have the really nasty stuff like Russia, Turkey, Poland, Czech, UK. UK is at less than half the valuations of the US. So most Americans listening to this have a massive 80% allocation to US stocks. So look beyond our borders. You want high dividend yields, you want low valuation. Look at some of these countries around the Western world, and we recommend at least getting to the global average, which is half in foreign stocks. That's uncomfortable for most. Most people only have 3% in emerging markets when the global market average is about 13%. So all of these factors moving together, we think 2030, so you guys have me back on in a decade, I think that the results will show that foreign markets do much better than the U.S. does. Okay,
Meb, good to have you here. Thanks for the walkthrough. Appreciate it as always.
Great to be here.
Thank you. Meb Faber is the CIO at Cambria Funds. Go to the Twitter page, check out, go to the research, and decide for yourself. Obviously, as Meb says, comes down at some point to predicting the future. Maybe you should shy away